There is a rule in trading so fundamental, yet so completely hidden by the noise of the modern world, that almost every beginner misses it entirely. The crowd believes that the price of admission to the financial markets is simply funding a brokerage account. They are told by marketing campaigns, social media, and brokers that if they have $1,000, a laptop, and an internet connection, they are ready to play the game. They are led to believe that the barrier to entry is financial, and once that barrier is crossed, wealth is just a matter of time. So, the average person pays that initial fee. They open the account. They spend weeks, maybe months, studying. They learn the patterns. They memorize the indicators. They test the moving averages, the RSI, the MACD, and the Fibonacci retracements. They fill their screens with colorful lines, searching for a perfect formula, a mechanical trigger that will tell them exactly when to buy and when to sell. And then they start. But weeks turn into months, and the account keeps bleeding. They win a little, then they lose a lot. They assume the strategy is flawed, so they change it. They find a new guru. They try a new indicator. They adjust the settings. Yet the result stays exactly the same. Eventually, the speculator sits there, staring at a flashing screen in the dark, wondering why a game that looked so simple on paper feels so utterly impossible in reality. The cold truth is that they haven't actually paid the real price of admission yet, because the market does not want a man's money. The market wants his ego, it wants his patience, it wants his peace of mind. And until a trader is willing to pay that psychological price, they are just a gambler donating capital to professionals. Most people enter this arena thinking trading is an intellectual challenge. They believe the person who can analyze the most data, read the most news, or find the most complex setup will win. It's a comfortable belief because it implies that if someone just works harder and gathers more information, they will succeed. But the market does not reward raw effort or intellectual pride. The market is not a math puzzle to be solved. The market is a mirror. When a person looks at a chart, they think they are looking at price action. They aren't. They are looking at a reflection of their own internal flaws, their insecurities, and their unresolved relationship with risk. Think about the average losing streak. How many trades fail because the technical system was inherently wrong? And how many fail because the human mind couldn't control itself when the pressure mounted? Fear makes a trader exit a perfectly healthy winning trade too early because they are terrified the market will take away a small temporary profit. They cut their winners short out of anxiety, denying themselves the large macro moves that actually build long-term wealth. Conversely, hope makes them hold on to a losing trade long after it has broken a defensive stop-loss. They pray it will turn around. They look at a declining position and refuse to accept reality, turning a disciplined, calculated risk into a catastrophic long-term investment out of pure denial. Greed makes them size too big because they want to make up for last week's losses in a single day, forgetting that leverage cuts both ways. And when the market moves against them, revenge takes over. Revenge makes them click the mouse button again and again, violently fighting a market current that is clearly telling them to sit still. A professional knows that a technical strategy is only 10% of the battle. The other 90% is managing the emotional fallout of complete uncertainty. The chart does not destroy the trader. The trader's inability to accept being wrong destroys the trader. This psychological pressure is amplified tenfold in the world of swing trading. Day traders get their answers fast. They enter, they exit, and the emotional pain or pleasure is over in minutes. They do not carry the burden of the unknown into the next day. But swing trading is entirely different. Swing trading is a slow psychological burn. For the swing trader, setups take days, sometimes weeks to form. They have to sit on their hands and watch the market move without them, resisting the urge to jump into subpar setups out of sheer boredom or the false belief that activity equals productivity. They have to develop the professional skill of doing absolutely nothing when the market conditions are not perfectly aligned. And when an entry finally presents itself, the real test begins. A swing trader must hold that position overnight. They have to go to sleep knowing that while they are resting, global news can break, unexpected gaps can happen, and their capital is exposed to the dark. They wake up in the morning, and the first human instinct is a tightening in the chest as they open the screen to see what the overnight session has done to their wealth. They have to watch price pull back into the entry, testing their conviction, shaking out weak hands. The amateur looks at a standard pullback in a strong trend and sees a disaster. They panic, assume the worst, and exit at the absolute bottom. The professional looks at the exact same chart, ignores the momentary pain, and recognizes value inside structural strength. Amateurs trade their emotional pain. Professionals trade the structural reality. If a person cannot sit with discomfort, if they cannot look at a red floating loss on a high-quality setup without feeling like their world is falling apart, they cannot swing trade. They will constantly cut trades at the exact moment before they turn around, and they will chase them at the exact moment the trend is completely exhausted. This is the reality of speculation. The modern financial world is loud, deceptive, and deeply toxic. It is filled with voices selling systems that promise certainty in an environment that is inherently uncertain. They sell the dream of the entry point, the perfect indicator, or the secret formula. But they never talk about the discipline required to execute those rules when your emotions are screaming at you to do the opposite. The market offers no magic indicators, no easy wealth, and no sympathy for pride or weakness. It is a cold, indifferent machine that operates on probabilities, not human desires. It does not care about your bills, your financial goals, or your need to be right. The true discipline of trading requires things most people prefer to ignore. Building a rule-based system that protects a man from his own worst impulses, surviving inevitable drawdowns without losing belief in a process, and learning to step away from the screen completely when the water turns dangerous. Those looking for excitement, entertainment, or a shortcut will always be forced to pay tuition to the market. They will bounce from strategy to strategy, blaming the indicators, blaming the brokers, and blaming manipulation, never realizing that the flaw walks in their own shoes. But for those who are tired of the noise, those who are finally ready to look into the mirror and face the actual psychological flaws holding them back, consistency begins with a simple choice. A choice to stop trying to predict or control the market and start learning how to listen to it. It requires a shift from wanting to look smart to wanting to be disciplined. It means understanding that protecting capital is the first priority and making profit is the second. To achieve longevity, a trader must learn to master the mindset, accept uncertainty, and flow with the current rather than fighting the current. To trade reality, not hope. See you in the next video.